you would argue that we shouldn't expect things to just bounce back to normal easily. How should investors think about what we need to know about the coronavirus before people's minds get more eased?
Yeah, unfortunately, it is looking at virus data, and we're all experts on the economic side rather than the medical side. But I would say any sign that we have clusters developing in a major city, whether it be in Western Europe or in the US, is going to get this market pretty riled up, and risk is going to take a knock. So I think we're going to have confidence that the virus data improves, really. It's got nothing to do with the economic data. We've already seen backward-looking economic data. We've really got to see the frontward-looking virus data now.
And how, Alan, should we think about what good data means? Because I can imagine a scenario where, yes, the virus does spread, but we realize, well, maybe it's not that fatal. Maybe here in the U.S. we're more prepared than people expected. Maybe this is, though certainly serious, not the end of the world. And so, therefore, we can go back more to business as usual. That wouldn't necessarily be a bad thing, right?
Well, that would be hopeful thinking, I think, or perhaps wishful thinking. There's definitely a sense that whilst you're trying to contain the virus, that's when you have the largest economic effects. If you actually give up in terms of containment, actually the economic effects might be more restrained. However, the human costs will obviously, tend to spiral out of control. So, there's that tension there.
And Alan, I wonder, Jeff, I wonder how you think about this and how the market is going to digest the continuing data that we get on coronavirus, especially as we understand what happens in areas like Washington State, Seattle area, San Francisco Bay Area, which are such important seats of corporate activity. Do you think the market over the next several days starts looking for information specifically out of those places, about more tests coming online? What?
I think, John, the key for the market is going to be some sort of certainty. I think looking at data out of China, again, the lack of trust of that data, I think, as was mentioned, the mortality of this disease, while initial numbers out of China pointed mortality to between 2 and 3%. Other countries have done a better job at perhaps fighting this. We also don't know how many cases people have gotten which have not been severe, have been quite mild, and maybe even asymptomatic. So that may, I think if the market got the mortality rate down on this disease, that would be wonderful. Certainly the flu in this country, the mortality rate's about 10 basis points. And if this virus were to be maybe in the 50 basis points, 40 basis points eventually, that maybe not life back to normal, but maybe the fear would be taken away. I think that would be instrumental for markets to find some sort of basing in here. And I think a vaccination, all these types of things, or even the ability to treat the disease more effectively would also be welcomed by markets. These are things that are out the windshield. We don't know how far those are in the future, but history says these are all coming. And history also says that these types of drawdowns in markets do eventually turn out to be buying opportunities if you're looking 12 to 18 months out.
With all the caveats that we just said, I mean, no one knows how this is going to go, how long it's going to take for us to get a sense of safety again. You think rates markets are overplaying their likelihood of a recession?
I don't necessarily think so. I think, there's a bit of a binomial distribution here. Things could turn out a little bit better, but things could certainly turn out a lot worse, really, as well. I think there is a lot priced in the short term. So, for example, Fed funds pricing in roughly 50 basis points for the next meeting. The Fed is very unlikely to do more than that. So I think that's
a mat.
Possibly, really. I think given how few bullets they have, I think they prefer to be doing 25 basis points, perhaps surprising the market in terms of timing. But you look at all the other central banks, RBA, Bank of Canada as well, coming up this week. There's actually more than 25 basis points priced in for those central banks as well. I can't see them doing more than 25 basis points, again, because most of the central banks don't have much to play with here.
Of all the statements we've gotten from Kuroda, Lagarde, Powell on Friday, did one surprise you? either in its relative dovishness or hawkishness compared to your expectations?
No, I think that was exactly what was expected, or should have been expected. I think the G7 finance comment that we should get tomorrow will say that they're prepared to act. That's entirely, a standard playbook, in my opinion. Then I think it's just exceeding the market expectations, which is going to be so difficult.
And then finally, Jeff, you say one of the things you're watching is consumer confidence. In this environment, what do you think is the key to that?
I think containment. I think issues of certainly there's some hoarding that went on over the weekend. So I think the more the consumers can feel that our governments are in control, that this is not going to spread wildly around the country, will be beneficial to consumers. Certainly, right now we have more of a supply shock than we do a demand shock, but we are monitoring that extremely closely. And consumer confidence, which again is tied very highly correlations to retail sales, is something that we have to keep an eye on here as this plays itself out.